The most revealing moment in any financial bubble isn't the collapse, it's the moment certainty feels complete. Prices are climbing, confidence feels earned, and caution begins to sound foolish, not prudent, not responsible, just behind the times. Long before panic arrives, belief has already settled in, not through deception or secret plots, but through ordinary people quietly persuading themselves that old rules no longer apply. By the time bubbles are openly debated, behavior has already changed. Welcome to a capital D code where markets are shaped as much by psychology as by numbers, where stories outrun spreadsheets, and optimism feels rational. Because in finance, as in history, the most dangerous ideas are the ones that feel obvious and aligned with the present. Every financial bubble shares a common illusion. While it is expanding, it rarely feels reckless or extreme, it feels sensible. Participants don't experience themselves as gamblers chasing momentum. They experience themselves as people responding logically to a changing world. The language surrounding the asset shifts early. Risk becomes opportunity, speculation becomes positioning. What looks excessive in hindsight feels measured in the moment. This is why bubbles are so difficult to recognize from the inside. They don't present as mistakes, they present as adaptation. This pattern isn't unique to modern finance, it has repeated for centuries because it is rooted in human psychology, not technology. Long before equity markets and digital platforms, people attached extraordinary expectations to assets that appeared to redefine the future. Tulips were not just decorative plants, they symbolized wealth, rarity, and a new market structure. Railroads were not simply infrastructure, they represented national progress and economic destiny. Radio stocks promised a transformed culture. The internet suggested the end of distance and friction itself. In every case, the underlying innovation was real. That distinction matters. Bubbles are not built on fantasy. They are built on genuine change, pushed beyond realistic limits. The driving force behind this process is not greed alone. It is narrative. Humans do not interpret the world through balance sheets. They interpret it through stories. Stories provide coherence. They reduce uncertainty. They explain why the future will be different from the past. When a compelling story attaches itself to a new technology or asset, belief forms before numbers can challenge it. Valuation becomes secondary. Metrics are treated as outdated tools designed for a world that no longer exists. Once belief leads, financial logic adapts to fit the narrative. Profitability is not rejected, it is deferred. Losses are not denied, they are reframed as necessary investments. High spending is justified as strategic positioning. When a story feels inevitable, math becomes something to work around rather than something to obey. This is not deception, it is rationalization. The story feels internally consistent, and consistency feels like truth. Social reinforcement accelerates the process. In uncertain environments, people look to others for cues. If prices are rising and respected participants are confident, doubt feels unnecessary. Markets amplify this instinct because price movement itself becomes evident. Rising valuations appear to confirm that the collective belief must be correct. Skepticism grows costly. Questioning the narrative begins to feel like misunderstanding progress rather than managing risk. At this stage, bubbles don't feel fragile, they feel established. What is forming is not hysteria, but consensus. And consensus is far more powerful than excitement. Once consensus takes shape, confirmation bias quietly takes control. Investors do not stop engaging with information, they simply become selective. Data that supports the prevailing story is emphasized, repeated, and shared. Contradictory signals are contextualized, softened, or dismissed as temporary distortions. Language begins to carry weight. Words like transition, long-term, and scale do heavy psychological lifting. Models are adjusted to align with expectations rather than challenge them. This is the stage where bubbles become self-sealing. Any criticism is interpreted not as a warning, but as proof that the critic doesn't understand the new paradigm. Doubt becomes a signal of ignorance. Confidence becomes a marker of insight. Over time, disagreement fades, not because risks disappear, but because questioning them feels socially and professionally expensive. Overconfidence follows, often in subtle forms. Rising markets reward participation, and early gains feel personal. Success is attributed to intelligence, timing, and superior understanding rather than favorable conditions. New participants believe they have discovered a unique opportunity. Experienced participants believe they have finally learned how to manage risk correctly. Almost everyone believes they will exit before the downturn arrives, despite overwhelming historical evidence to the contrary. Luck and skill become indistinguishable until conditions change. Authority bias adds another layer of protection around the belief system. When major institutions participate, confidence hardens. Bullish reports from large banks, endorsements from respected funds, and supportive policy environments reduce perceived risk. At that point, the asset stops feeling speculative. It begins to feel validated. Participation itself becomes proof of legitimacy. The system appears stable precisely because so many powerful actors are involved. None of this feels reckless while it is happening. It feels coordinated. It feels like progress unfolding as expected. Prices rise, volatility becomes familiar, and caution feels increasingly unnecessary. People don't stop thinking. They simply stop thinking in ways that create emotional discomfort. This is why bubbles are rarely identified in real time. They don't feel like madness. They feel like alignment between belief and reality. The paradox is that the stronger the consensus becomes, the harder it is to see the assumptions supporting it. By the time the bubble is visible, it already feels normal. Excess doesn't announce itself. It fades into the background. Risk becomes abstract. The dominant question shifts from sustainability to participation. No one wants to be left behind by what appears inevitable. Modern bubbles do not require dramatic speculation or mass hysteria. They can form quietly, driven by institutions, capital concentration, and benchmark pressure. Today, belief does not need excitement. It needs compliance. Large flows of capital can inflate valuations without widespread enthusiasm. Simply because incentives reward alignment over caution, this brings the discussion to the present. Increasingly, investors are questioning whether artificial intelligence represents the early stages of another bubble. Not because the technology is fake, but because expectations surrounding it may be expanding faster than current economics can justify. This distinction is critical. Every historical bubble was built on something real. Railroads transformed transportation. Electricity reshaped industry. The internet permanently changed communication. The dot-com bubble didn't collapse because the internet failed. It collapsed because capital assumed immediate, universal, and perfectly monetized adoption. AI follows a familiar trajectory. The technology is real. Productivity gains are real. Long-term impact may be substantial, but markets do not price inevitability. They price expectations, and expectations are shaped by psychology. In recent years, a small group of AI-linked firms has driven a disproportionate share of market gains. Index performance has become increasingly concentrated, a familiar ingredient in past bubbles. When capital funnels into a narrow set of symbols, those symbols begin to carry narrative weight beyond their financial reality. Valuations rise not only because of projected earnings, but because of assumed dominance. Margins that do not yet exist are treated as unavoidable outcomes. Heavy investment is framed as strategic necessity. Profitability is postponed until after scale, after capture, after disruption finishes rewriting the rules. Positive signals are amplified. Adoption headlines are celebrated. Rising costs, competition, and regulatory pressure are contextualized away. At the same time, institutional participation strengthens belief. When major funds and index providers increase exposure, participation itself becomes validation. The central question shifts. It is no longer what is this worth? It becomes what happens if this continues and I'm underexposed. This psychological shift defines late-stage belief formation, not panic, not mania, quiet alignment. Bubbles do not burst because everyone suddenly realizes they were wrong. They burst because a single assumption breaks. Growth slows, costs rise, capital reprices risk. When the narrative loses coherence, confidence reverses direction abruptly. Social proof flips. Confirmation bias hunts for negative signals. Liquidity retreats. What once felt inevitable suddenly feels fragile. What once appeared unshakable can suddenly feel uncertain. That SY bubbles are always clear after they burst and almost impossible to recognize while they grow. So how do you respond to that reality? Not by trying to forecast crashes. History makes one thing clear: timing collective belief is nearly impossible. The real defense isn't prediction, it's awareness. The more useful question is rarely "is this a bubble?" It's "what assumptions am I depending on?" If growth slows, what no longer holds? If capital becomes more expensive, what changes? If expectations reset, what still makes sense? When decisions rely more on narratives than on cash flows, time becomes a risk factor. When valuations assume flawless execution, patience can quietly turn into exposure. And when certainty surrounds you, that's often when caution matters most. Markets don't repeat because technology evolves. They repeat because human behavior doesn't. Bubbles don't form because people are foolish or reckless. They form because shared belief feels more comfortable than uncertainty, until it suddenly doesn't. Those who endure aren't the ones who perfectly anticipated the future. They're the ones who examined their assumptions honestly. That's the lesson beneath every crash, every chart, and every retrospective analysis. If this perspective added clarity, consider subscribing. History doesn't predict outcomes, but it does reveal patterns.